Welcome to YP Investors Quick Tips. Today we'll be going over how to generate safe income from selling put options. Let's go over to YP Investors homepage, and from here, once you're logged in, let's navigate to the Tools tab, go down to the top stocks and sector ETFs, and then we'll go down to one of the stocks on the list here, MAG. And this is a MAG Silver Corp. So it's a precious metal sector stock. And what we're going to be going over today is how to generate income from selling a put. And that means you're going to buy the stock at a certain price if it's below that price by the time the contract expires. So you'll be forced to buy it. If the put is at, let's say we're going to sell a put at $12, then that put expires at the end of this week or the end of next month. If the stock ends up below $12, you're going to be assigned and you'll have to buy it for the $12 per share. And one contract is 100 shares. So to do this, you have to at least have $1,200 to put down, because you'll be forced to buy it at the $12 price, because that's what the contract you set up to do for the put. So what you can do is, and then another additional thing that I want to add is, during the life of the contract, if the price is below that $12 strike price is what it's called, you could be assigned to buy them at any moment, even if it does end up going back up at the end of the contract, which is not bad. And thus is the reason it's not bad when the stock price does end up going up, because you're going to make money both ways. And when you're selling the put, you're going to be gaining that premium that the buyer of the put is going to be paying. So the buyer is going to be paying you money to put this, to have the chance at you buying the stock at $12, because he is thinking on the other side of this, he or she, they're thinking, I'm buying this put because I think the stock's going to go way down. But you're willing to risk it because you're like, well, this is actually a good stock and a positive trend, so even if it does go down temporarily, I think it's going to go up in the long term. So sure, I'll buy in, I'll take your premium money and I'll have that as my income, and it'll actually reduce the price of entry for the stock. So what you'd want to do when you want to sell a put here is, so we just see this double top buy signal at $12. So that's a good time to buy in if you want to buy into the stock, and this is one of the top technical stocks on YP Investors for this week. So okay, let's get into this stock. Let's say you want to buy 500 shares of this. So you have to have, the strike price is $12. So that's going to be $1,200 per contract you're going to have. So 1,200 times 5. Let's do that math quick. I think it's 6,000. Or, yeah, 6,000. And then, so you're going to have $6,000 just to put down. But then the next thing to decide is when do you want this contract, how long you want this contract to be, when will it expire. So when I'm doing this, I'm looking for the shortest term, and most stocks are going to be monthly contracts, and some of them are even weekly, and those are really nice because then you can get in and out. You know, if the stock does, or the market does turn bad, you can just, it's only a week stock or a week option, so you can get out of it and sell out of the stock if you did get assigned them within that week. The month ones aren't as bad. You can always sell the contract back to another person that's going to buy the put contract that you're doing, but it might be at a lower premium, so you might, the money that you had gotten paid, you might have to give all or some of it back. So we want to buy we want to sell 5 put contracts at $12 strike price for, let's say, the end of the month. Now there's going to be a premium per stock per contract paid to us. So let's say it's $1. So that means it's $1 per stock. So it means it's $100 per contract. So we're going to get paid $100 times 5, $500 to invest in this stock and sell the put. So we're actually going to be possibly buying it at $12, but we get paid $500 in the meantime just to put the risk out there. So if you do get assigned it, great, you got in at $12 where it was a buy signal, but you actually got in a little bit cheaper because you got in at, let's see, 6,000 minus 500 divided by 500 shares. We actually got in at $11 because you got paid the $1 premium. So that lowers your entry price. And then if we did get assigned this at the end of the month, let's say it was at $11.50 or even $10, you know, maybe we overpaid a little bit, but that's the risk you're going to have to take when you're being on the selling side, because you're going to get assigned the contract if it's below $12. But we know this is a positive technical stock, so we know in the long run it's going to be positive. Odds are the stock price is going to go up. So if we made this $500 extra and we actually got in at $11 per share, and now if the stock price goes up after we got assigned, then we're going to be holding a good stock in the long term. And now this is the good side of it. If the stock price ends up above $12, then we don't get assigned any contract and we can just keep the $500. So you just made $500 either in a week or a month, however long the contract was. In our case, we said it was going to be a month. So you make this $500 and then you still have your $6,000 to go invest in something else, or just do the same thing next week or the next month whenever you want to continue to do this. So if you're doing this with positive technical stocks, the odds are that the stock price is going to be above the $12 by the time the contract ends. So odds are you're just going to be making these $500 if it's the same option premium each month or each week, if you continue to do the same thing with these positive technical stocks. And typically the premium that I shoot for is between 2 to 4%. So on 6,000, I think that would be, let's see, $120. So that would be, so 500 is a pretty aggressive premium, but you can get those, especially if the stock price is really low. If the stock price was at like $10 and you're going to do a $12 put, you're going to get paid a lot of money to do that. Or even the $11 range, you might be able to get the $500 premium at that time. But that's something to keep in mind. And this strategy is good for just a safe way to generate income, because worst case scenario, you own a good technical stock. Best case scenario, you just made $500 and you can continue to do this each month, each week, as often as you want. It's always good to buy in at the buy signals or have the strike price at that buy signal, because odds are it's going to be going up past that buy signal, and that's where you'll be assigned if it's below that, and you just make the income if it's above that. Our YP Investor quick tip for you today is to try the strategy out. Either try it out paper trading or just try it on your own without buying in. See if your strike price and the premium would have worked out for you, and then actually implement it. And keep in touch with YP Investors, and good luck in your investments.